In this video, I will be discussing my performance in the first year as a prop trader. I will begin with an introduction to give you some context, then I will go into details about the numbers and figures. In June 2015, I was offered a one-year contract to trade Forex on behalf of a private family office. One of the conditions of the contract was that I cannot disclose any information about my trading results using their money. This was a disadvantage for me because my ability as a trader is defined by the results that I can produce. If I cannot show the numbers, then there is no way I can demonstrate my abilities if I want to go trade for other firms in the future. After some negotiation, I was given permission to replicate the trades on my own account with a few restrictions about what I can and cannot disclose publicly. So I opened an account with Pepperstone and used my own money to create a model of the account that I am trading with using the firm's money. On my blog, you will find that I have 3 accounts linked to my FX book. The PAM Growth account is the one that I use to replicate the trades. I update my performance on a monthly basis, and I also show my broker account statements with the most confidential information blurred out. If you go to my blog and click on the audit page, you will find the full audit report. Here are the performance metrics numbers. There are a few metrics that are not yet available, such as annualized return and Sharpe ratio, because they require at least 2 years of history. I will be able to show them for the next report. All of the numbers are calculated after trading costs. I am trading with a positive expectancy, so there is no doubt that I am making money. This is expressed in units of risk. To give you some context, expectancy of 0.57 means that for every dollar I risk, I make 57 cents back. My trading methodology has exit signals, and this is reflected in the low win rate. I choose to close trades when exit signal comes up to keep losses small. The small and frequent losses are offset by the big winners. On average, my wins are over 3 times larger than my losses. This is fascinating to see because my trading plan only allows me to set targets at 2-to-1 reward-risk ratio. So, in theory, my average reward-to-risk ratio should be 2, but it is actually 3.06, which is 50% better than what it should be. We can see this effect on the trade distributions graph. Wins are in green and losses are orange. The green bars are much bigger than the orange bars. I had 6 losses in a row happen twice during the year. The first one was here, and the second one was here. By keeping losses small, I was able to keep drawdown very low even after 6 consecutive losses. My recovery factor is 4.12. This is a measure of how fast the account recovers from drawdowns. Some of you might say that 3.79% gain for the whole year is pretty low, and you can get that in almost 2 trades. Well, you need to put this into context. This page shows my actual performance in comparison to 3 hypothetical scenarios. I was trading with extremely small position size. This wasn't up to me. I was a new trader and they didn't want me to go full-blown trading big positions. So on average, my position size per trade is 0.25% with a set limit of 0.40. With my trading methodology, I have the ability to step up position size when certain setup shows the right conditions. Likewise, I am also able to step down position size if I can see that there are extra risks that needs to be managed. If you compare my performance to, say, a typical scenario where a trader would risk 1%, then this is what my result would have been if that had been the case. On a 1% risk, I would have finished the year at just over 15%. Maximum drawdown 3.66, and maximum observed exposure 3.07. Maximum observed exposure is the measure of how much of the account was exposed to the market during the first year. So my methodology is quite conservative. The account is rarely overexposed in the market. If I were allowed to trade bigger position size, say 2% per trade, then I would have finished at just over 29% for a year. Maximum drawdown 7.03 and observed exposure 6.04. Throughout the years, I've had lots of questions coming in asking about my trading methodology, particularly why am I so obsessed with risk management and protecting myself from losses? Well, now you can see the reason why. With my methodology and the way that I trade, primarily focusing on keeping losses small, I can actually scale my performance up using bigger position size in order to have bigger gains without going through the larger drawdowns. Whether this will happen or not this year will depend entirely on my new contract. I have passed my first year annual performance review with the firm and I'm just awaiting for the new contract to come. I am positive that I would be allowed to trade bigger position size, and I am hoping that I will also be able to trade with more money. The point that I want to make here is that profitable trading can be achieved using very conservative and defensive strategies. A lot of the things that I learned are from people who trade very defensively, and they produce very good results over the lifetime of their trading career. This comes down to the fact that winners and losers comes in streaks. You never know what the next trade is going to be. My principle is that I protect myself. By taking small losses, my focus is to protect my account. If I can survive the losses with as much money as possible, when the winners come, I would be able to make more profits on top of that. The second point that I want to make here is that you don't necessarily need to focus on profit taking in order to maximize your profits. I can tell you that in my trading plan, I have one sentence to describe how I set my target and how it needs to be managed. I always use one single target at 2-to-1 risk reward. It never moves. It is never pushed up or down. It always stays the same. My focus is purely on keeping losses small. Some of you may know the reason why I do this. It comes down to purely the efficiency. The mathematics tells me that keeping losses small is slightly more efficient at producing higher expectancy than if I was to extend my target. On a personal level, I'm a trader where I can take small losses better than, let's say, holding out for a trade and extending targets. That comes down to personality. What I want to do next is to do a Monte Carlo, or to attempt to do a Monte Carlo simulations on my account. The idea is that if a trader is long-term profitable, it does not matter what order the trades would come into. As you can see, in reality, you cannot have a straight line up. It does not happen. You have to take some losses, and so you get these ups and downs, which is a natural movement of the account equity if you were trading in real life. Right. So I'm just going to randomize some numbers, assign that, have it sorted, and let's have a look. There we go. You can see that the account balance changes and the distribution of the trades also changes in order. The account balance is compounded here, so I'm not just simply rearranging the trade order, I'm also compounding the effects that it has on subsequent trades. Now, I can guarantee you that I can hit this button as many times as I like to infinity, and I will always end up with a positive result at the end. And this is what it means to be trading with positive expectancy. Over a large number of trades, if you have positive expectancy, you should come out on top. I want to finish this video by saying that the reason why I do what I do with my blogs and my videos, and even with this audit, is to set an example when it comes to accountability and transparency. As you know, there are a lot of people who claim to be profitable traders with great returns, yet they do not provide any proof or evidence that allows you to verify their claims. I hope that somebody who comes across my blogs and videos will be able to see the reality of trading. I hope that the materials that I put out there will allow these new traders to keep their hard-earned money safe away from those scammers who are offering them systems and strategies without actually being able to trade. Technical analysis and trading are not the same. You can be an excellent technical analyst. You may know 10, 20, 30, 40, 50 different technical patterns, but if you never place a trade in your life, you would not have the skills required for trading. Unfortunately, in this industry, there are a lot of great analysts out there who think they can trade and are offering courses, systems, and even managing money. I hope that if you are one of these new traders, then please choose who you listen to very, very carefully. Ask yourself, are their trading results verifiable? Has it been audited? Are they consistent with what they're doing? There are plenty of reputable educators out there that you can learn from, and I hope that you will be able to make the right decision. Thank you for watching this video. I'll speak to you again in the next couple of weeks. Bye for now.